Welcome back to Trading with CJ. Now today we're going to be talking about what is pound or dollar cost averaging and how does it compare to lump sum investing. So first off, pound or dollar cost averaging, well, it's the same thing. It just depends on whether you're from the US or the UK, pound or dollar. And essentially what it is rather than investing all of your money in one go or a large portion of your money in one go, aka lump sum investing, you are putting in smaller portions in different stages over a longer period of time, pound cost averaging. So what are the benefits of this, and is it better than lump sum investing? Well, it really does vary on a few different factors. What type of stock it is you're investing in, how volatile that stock is, and how long you're planning on holding that stock for. So in general, if you're more of a conservative type investor and you don't really like taking risks, then you're more likely to go for a cost averaging approach. Whereas if you're a bit more of a risk taker and you kind of want to just put your money in and be done with it, then you're more likely to go for a lump sum investing approach. Or you could be a bit of both. So let's take a look at an example here of where dollar cost averaging would have worked in your favor. So we can see here, in this example, we're investing $8,000. The lump sum investor is just putting the $8,000 in one go, and they've got that at $10 a share. Whereas the cost averaging investor is putting in monthly investments of $1,000 over an 8-month period. You can see they've bought some shares at $10, some at $14, some at 7.5, etc. Now over the course of the 8 months, the lump sum investor would have made a 0% return on their investment because the share price is back to $10 after being volatile throughout the 8 months. So they've made 0%. Whereas because the cost average investor has been buying at various prices, getting some low prices of 7.5, some higher ones, they've got the average price. Therefore, after 8 months, they would have made a percentage return of 4.07%. So in this situation, because this stock is quite volatile over a shorter period of time, cost averaging would be the better solution. So now let's take a look at a more long-term example of where lump sum investing would have actually got you a better return on your money. So you can see here, we've dated back to 1995. Now as a lump sum investor, they've put £200,000 in one go. Whereas the monthly instalments will equal £833 for an average investor. You can see here that the £200,000 has been quite volatile. It's been up and down. It's a lot more volatile than cost averaging. However, over time, you can actually see that the £200,000 from the lump sum has turned into over £500,000. Whereas by cost averaging, it has turned into about £350,000. So it's actually worked out a lot better in terms of return of your money to lump sum invest over the longer period of time. Whereas you'd still make a profit either way, and it might be more volatile lump sum. However, you can see there's more money that's been made from doing that. So if we take a look at the S&P 500 graph from 1995 to 2000, if you put in $100,000 in one go, you've now made a return of over $300,000, whereas cost averaging would have made a return of around $250,000. So whilst yes, it's a massive profit on both instances, you can obviously see that it's slightly higher had you lump sum invested in the first place. Now this is on a graph where it's pretty consistently going up over time, so the longer period has resulted in better returns for lump sum investing. Now in this graph, this is the S&P 500 from 2008 to 2013, and you can see if you purchased around the start of 2008, you've pretty much purchased at the wrong time because the market crashed massively. Therefore, if you lump sum invested in 2008, you would only just be starting to see returns. Whereas if you were averaging over that period of time, in this instance, it would have worked out better. You'd have got a better return on your money. Now, none of us can predict when a market crash is going to happen or try to time the market. And as the famous investor Warren Buffett says, time in the market beats trying to time the market. So as you can see, if you're buying good quality companies that are continuously growing and you're planning to hold these for a long period of time, then lump sum investing could be your best bet. However, at the moment, we are in extremely volatile market conditions, with some stocks dropping 5 to 10% per day. So for me personally, dollar cost averaging those positions seems like the better option, and it's my preferred preference at the moment. So I hope you found this useful, and in terms of seeing some benefits to both of these options. Now I just want to say I'm not a financial advisor, so if you are planning on investing using either of these options, you should always do your own research first. So I hope this has helped you to understand the difference between both of these and the benefits for both. And if you have found this useful, please hit the like and subscribe button, and let me know in the comments below, are you cost averaging at the moment, or are you lump sum investing? What are you doing with your positions at the moment? Thanks for watching, and until next time,